and welcome to the Investing on the Go podcast. I'm Chris Sarley, and today we're joined by Yu Zhang, manager of the elite-rated Matthews Asia ex-Japan Dividend Fund. Thank you for joining us today.
Hi, Chris. Thanks for having me.
It's no problem at all. You are based in Hong Kong normally. Now, how often does that give you the chance to visit the broader Asia region? And can you tell us something you sort of learned about your recent visit?
Yes. I actually just recently relocated from San Francisco to Hong Kong since April this year. So before I was based in the US, I normally do a quarterly visit to different markets in Asia, spending anywhere between 8 to 10 weeks throughout the year, seeing different companies. And since April, I'm in the region, so hopefully I will be able to do more extensive visits, assuming quarantine measures in China or in Hong Kong starts to get eased a little bit. My last trip to the region actually happened in late May, early June. I visited Japan, Thailand, and Vietnam. A couple of major takeaways for me. First, reopening in Asia. It is getting quite a bit of momentum. I think different economies outside the mainland China are starting to learn, quote unquote, how to live with COVID. So you are seeing companies and the people are starting to come back to their office, and the economic activities are starting to recover in a fairly meaningful way. And secondly, despite all the macro uncertainty, whether it's inflation, US Fed rate hike, actually when you see company on the ground, you actually can see that what we call the structural growth story of Asia still is very much alive. So there are a number of companies I met, in Japan, in Vietnam, that can give you that kind of pretty robust, long-term sustainable growth despite the uncertain macro backdrop. So those will be the major takeaways for me from my last trip.
Okay. Let's quickly turn to the yield of the dividend on the fund. Could you maybe just explain the sort of levels that we're talking about? I know obviously the fund sort of invests in mid and small cap companies that are sort of growing their dividends. And is the fund suitable for income investors, or is it more for growth investors that would sort of benefit from the reinvesting in dividends? Maybe just talk us through the profile of the fund in that sense.
Yes. I actually like to position this particular ex-Japan dividend strategy as one of the core holdings for investors who wants to get the exposure to the structural secular growth story of Asia, but at the same time can still benefit from owning a dividend-paying company in terms of the quality and the better corporate governance standards. So when we manage this dividend-paying portfolio, we don't take a pure high dividend yielding approach. Rather, we take what we call a total return approach, essentially investing in both higher dividend yielding stocks balanced with faster growing companies. But these growth companies in our portfolio tend to pay a growing dividends as well. So that's a nice combination we think can give you both the income component as well as the growth optionality by investing in a emerging market like Asia.
Obviously, when we're talking about a fund that's focusing on Asia, we'd be remiss to sort of not focus on China to some degree. Clearly, you've got some of the considerable weightings to China and some of the big tech companies in your top 10. Can you talk to us about Chinese growth, and do you have any sort of worries about government intervention? Maybe just give us a view on that. Yeah,
I think concerns on Chinese economic growth has been such a big topic, this year, us included. So that's one of the most debated topics within our own team, looking at our exposure to China. Having said that, we also recognize that China is operating well below its potential growth capacity, mostly due to its very restrictive zero COVID policy. And it just, for your information, I'm right now speaking to you from a quarantine hotel in Shenzhen. Just came across board from Hong Kong to Shenzhen yesterday. And I can tell firsthand that a bustling city of Shenzhen right now is also look very much quiet due to the COVID measures. And from an investment perspective, I think a lot of these uncertainty or the growth headwind China is facing this year actually have already been pretty fully reflected in terms of a very poor investors' sentiment, as well as very discounted, cheap Chinese equity valuations. So that's why I think from our bottom-up stock picking standpoint, when you have those conditions in place and you actually honing on companies' individual business fundamentals, China today is a very much deep, diversified economies, while the overall macro environment in China is not the best at the moment. But from a bottom-up standpoint, you can still focus on several industries or sectors where we think will continue to enjoy a very strong secular growth tailwind. For example, industrial automation, biotechnology, semiconductor manufacturing. All these are the areas I think China is very much focusing supporting its domestic champion, so to speak. So those will be the areas I think for our exposure in China, trying to find these secular growth stories, given the breadth and the broadness of the Chinese market, despite a very uncertain macro backdrop. Regarding your comment on government intervention, obviously what we saw last year, specifically for these internet platform businesses, a lot of the negative impact already was playing out in a dramatic fashion in the stock market. At this moment, it's only my personal view. I think actually the peak level of the government intervention targeting these internet platform companies probably have already passed. And at this moment, the key focus for the government is trying to stabilize the economy. And for the audience, these internet platform companies in China, they are some of the largest employers in the country, directly and indirectly, employing tens of thousands of workers, and including some of these individual small merchants. So the impact on the overall economy is going to be really quite significant. And that's why I think the government at this moment is actually prioritizing supporting the growth, not necessarily doubling down on the intervention to these businesses.
Do you think, just to follow up on that, do you think the market has fully appreciated that, or do you think that some of the valuations still look quite attractive?
Valuation continue to look very attractive for, from our standpoint, even from a income or shareholder return policy. For the first time, you are seeing some of these internet, traditionally, high growth companies actually starting to pay dividends for the first time, or starting to do very significant share buyback programs, mostly due to a very distressed equity valuation they are seeing in the marketplace. I think headwinds are still persisting, slowdown of the Chinese economy or uncertainty related to these U.S. listed ADRs. So geopolitical tension, those will continue to drive near-term volatility on these growth businesses in China. But I think the long-term true value embedded in the business are starting to emerge in a meaningful fashion.
Okay. I want to turn to Vietnam, which is another area you have some exposure. Could you maybe talk us through why you're finding so many opportunities in that specific part of the market?
Yeah, I think actually, if you think China is taking a lot of the beating related to COVID, related to tense geopolitical relations, Vietnam actually is sitting squarely on the other side. Not only the country or the economy is reopening in a meaningful fashion, but also Vietnam has been one of the major beneficiaries as global companies are starting to diversify their supply chain, away from China. And if you look at Vietnam today, it is operating with a very young population, and the labor costs continue to be very competitive. At the same time, government in Vietnam is pursuing a market-friendly reform policy. So all these are music to ears for multinational companies. So we are seeing a pretty strong top-down, positive case. FDI, foreign direct investment, continues to pour into Vietnam, creating a lot of well-paid jobs for Vietnamese workers, and that really creates a very positive backdrop to support the domestic consumption. So back to your question, we've been investing across different sectors, in Vietnam, including some of the financial businesses, traditional commercial banks, real estate developers, modern retailers, as well as consumer branded companies. All these are very much domestic focused and actually are benefiting at this moment from a rising wage growth and rising household income in Vietnam.
Okay. One of your top 10 holdings recently IPO'd on the Hong Kong Stock Exchange. And in fact, I believe it was one of the biggest Hong Kong listing of the year. Could you maybe talk us through that a little bit and what Hong Kong listing means for existing investors in these Chinese listed shares?
Yes. So the company we own actually is mostly listed in domestic Chinese Asia market. Mm-hmm. And this year they decided to do a dual listing in Hong Kong Stock Exchange. I think from an existing Asia shareholder standpoint, listing in the Hong Kong market provides two things, mostly in my view. One is it is a pretty transparent and open sort of platform for companies to raise fresh capital to support their business growth. So you will have this constant access to a potential fresh capital to sort of provide the funding needs to grow the business. So that's a positive for the corporates. And secondly, from shareholder standpoint, Hong Kong market is much more dominated by institutional investors, vis-a-vis in the domestic Chinese Asia market. Still, retail investors take up majority of the trading activities. So if the company has the opportunity to introduce a new set of slightly longer term minded institutional investors into its shareholding base, I think actually it will produce a positive sort of outcome over the long period of time. You have a more stable shareholding base versus a more short-term sort of day trading mindset type of retail investors. So I think that's a added benefit on top of the access to additional capital.
And just one other question in terms of the characteristics of some of the companies you look at. I mean, do you find there are any sort of inherent differences between investing in Asian shares versus, say, Western markets?
Yeah, I think actually from a dividend investing, point of view, the source of dividends coming from Asia is quite more diversified compared to a typical dividend paying businesses in the mature markets. I think probably due to one reason, in the case of Asia, you see that many of the growth companies actually they tend to continue to have a very concentrated shareholding structure. In other words, the original founders or the founding families of these fast-growing Asian companies continue to own a meaningful stake when they listed the company. And compared to the Western, world, the equity market tends to be more institutionalized. So the shareholding structure is quite fragmented. You don't have a single outsized controlling shareholder, as much as what you would have in the Asian context. And that actually is quite important from a incentive for sort of argument when it comes to paying dividends, because the founders, they own such a large stake in these even fast growing Asian companies. These founders or the founding family, they will have their own incentive in terms of extracting cash from the listed entity to meet their own financial needs, and put in place a dividend policy, despite the business itself still is growing pretty nicely. but founders always have their own financial needs. So dividend actually serves that purpose pretty well. And also, it is one of the measures that you stay clear from potential corporate governance sort of red flags. Because when it comes to receiving dividends, depending how much you own in the business, whether you're a majority, whether you're a minority, you always get your fair share. So we, as a public investor, we definitely prefer a dividend payment versus other creative, quote unquote, connected party transactions in terms of extracting cash from the companies. So that, to a certain extent, you will see that in Asia, many of the fast-growing sectors, for example, healthcare, technology, consumer brand businesses, because of the dynamic we just discussed on the shareholding structure, a lot of the growth companies within these growth, quote unquote, growth industries, growth sectors, are also paying dividends along the way, and that makes the whole portfolio for the Asia dividend portfolio is a much more diversified and actually quite more interesting versus a typical more mature business that you tend to find in the in the Western market.
Okay. You also invest in a company that makes synthetic diamonds. I mean, that sounds quite interesting, but I mean, one, our engagement ring is going to be cheaper in the future, and are they just going to be synthetic completely?
Yeah, it's a very good example you catch. Actually, at this moment, for this particular company, the end demand is mostly coming from a more developed part of the market. As you may see in both Europe as well as in United States, especially within the younger consumer generation, they are starting to prefer synthetic or lab-grown diamond over natural diamond for no other reasons than a better ESG considerations. You may have heard the term bloody diamond. So I think that is starting to creep into young consumers' mind when they try to pick where and how they're going to spend their money. So this particular company in the portfolio, I think fortunately is positioning itself pretty well with this growing emerging trend. So we continue to like that stock.
Okay. And just lastly, how do you look at sustainability when you are considering investments for the portfolio?
Yeah, we really actually incorporate sustainability into our bottom-up stock picking analysis. We think, sustainability or ESG analysis is just a part of the total package when we try to understand better the company's overall business model, and all these factors surrounding environmental, social, and the governance will, to different degrees, affect the company's ability to grow itself and also affect its ability to deliver a sustainable earnings. And earnings growth usually is the most focused area for investors. And we just think ESG or sustainability is part of the total analysis you have to include in today's world. So that is a full sort of integration, including sustainability into our fundamental research process.
Thank you very much for joining us today.
Thank you, Chris.
And if you'd like to learn more about the Matthews Asia Ex Japan Dividend Fund, please visit FundCalibre.com. And while you're there, remember to subscribe to the Investing on the Go podcast.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.